Good morning. Hi everyone. My name is ANSHUL DILLON. My student ID is MGC8011. Today I am here to give my presentation for corporate accounting and my assignment title is Accounting for Income Tax. Let's begin with introduction. Taxation plays an important part in any business because tax expense is a major expense in any organization. Apart from this, accounting is also a very important part of any business. The calculation of profit is a major part of both accounting and tax directorate. There are separate rules and regulations for the calculation of profit in both accounting and taxation. Because of these different rules and regulations, there are differences in tax expenses according to tax laws and according to accounting policies. In, Incorporating those differences into books of accounts are called accounting of taxation. Accounting of such taxation is the most critical and crucial part of the accounting of taxation. It has been important to analyze the key aspect of the different financial statements such as profit and loss, balance sheets, cash flow statements. It can help the investors to take valuable investments decisions in their future projects. However, it can further convey the crucial operational activities as well as financial data of CBA that are incurred during the last 2 years' time. Deductibility temporary differences. When a taxable temporary difference is getting reversed, then such taxable temporary difference is called deductible temporary difference at the time of reversal. For example, when in current year taxable income is lower because of the higher depreciation rate in tax laws, then such difference is called taxable temporary difference. But in future years, when depreciation of accounting is more than the depreciation of tax laws, then such difference is reversed, and then in the year of such reverse it is called deductible temporary difference. Recognition of deferred tax assets and deferred tax liabilities. Recognition of deferred tax liabilities when due to taxable temporary difference tax payable as per tax laws in a particular year is less than tax payable as per accounting policies, then such difference in tax payable is recognized as deferred tax liabilities. Recognition of deferred tax assets. While recognizing deferred tax assets, we must care about the concept of prudence. We require certainty that such deferred tax assets will give us future economic benefits and getting reversed in future periods. While recognizing deferred tax assets, we must ensure that the organization will be a going concern in future periods. There are adequate profits of reversal of such deferred tax assets. After analyzing the above table, we see that tax expense is increased from last year, which shows that there are chances of higher revenue as compared to last year. After analyzing note 3 of the financial statement of CSL Limited annual return, we also get to know that there is a deferred tax recovery of $7.2 million and unprovided in a prior year is $13.3 million. Profit before tax for the year 2019 is $2,341 million and tax rate in Australia is 30%. So according to the tax expense should be $702 million, which is a theoretical tax expense, but in the financial statement actual tax expense is $422 million. So we can see that tax expense is not the same with the company tax rate times companies net profit for the year. With the help of the below table, we can understand the reason for the same. After analyzing the above table, we get to know that there are some benefits provided by tax laws because of which theoretical tax expense is not equal to the income tax expense of the financial statements. Different tax rates of the other countries reduce tax liabilities of $256 million. There are some incentives provided by the government on research and development. Because of these incentives, a reduction in tax liabilities of $25.5 million, $25.5 million, and there are some more reasons which reduce the or increase our income tax liabilities. Deferred tax assets and deferred tax liability of CSL Limited and reasons therefore. Deferred tax assets are recognized by CSL Limited based on the recognition of criteria of deferred tax assets. Deferred tax asset is created on the taxable temporary difference after considering virtual certainty of future economic benefits. Deferred tax liabilities are recognized by CSL Limited based on recognition criteria of deferred tax liabilities. Deferred tax liabilities are created on taxable temporary differences after considering the reversal of taxable temporary differences. Income tax expense. Income tax expense is a revenue nature of item, which means it is the current year's tax expense shown in the income tax statement of the corporate entity. Income tax expense is calculated on current year profit. Therefore, all amounts which are considered for calculation of income tax expenses are related to current year only. Income tax payable. Income tax payable is a personal nature of account. It should be shown in current liabilities of the balance sheet of corporate entity. Income tax payable is a short-term liability that is required to pay in the future. Income tax payable means due to government authorities against a current tax liability related to current year tax expense, or it can also include any tax liability pending from a long time ago. Credit availability. There is a credit available to the organization in respect of tax deducted at the source, so this credit is not shown in the cash flow statement. While it is a part of the income statement, income tax expenses. In cash flow statement, only cash inflow or outflow are stated. It means that cash flow statement is purely on a cash basis. While on the other hand, income tax expense shown in the income statement is as per actual concept. It is tax or income whether received or accrued. Tax laws and regulation. Tax paid shown in the cash flow statement is simply cash outflow. On the other hand, shown on the income tax statement is income tax expense is calculated with the help of tax laws and regulation. Key important interesting points about the tax treatment of CSL Limited. CSL Limited is a multinational group having operation in several countries like Switzerland and the UK. So there is the involvement of tax laws of other countries which made it difficult to calculate correct tax liabilities as per different taxation laws. Apart from this, it is also interesting to assess virtual certainty for the creation of deferred tax assets or liabilities. For example, deferred tax assets or carrying forward tax losses are principally recorded in CSL entities in Switzerland and UK. So for the creation of deferred tax assets, we have to see that there should be probable future profit to set off those losses in future. There are some tax losses which with no expiry date of $0.4 million on which deferred tax assets have not been created because the availability of future taxable profit utilization of the said losses is not probable. Temporary differences versus permanent differences. Temporary differences they arises because of differences in taxation laws, accounting concepts and policies. Temporary differences are main cause of creation of deferred tax assets and deferred tax liabilities. Taxable temporary differences will create a difference between theoretical tax expense and actual tax expense, but all these differences are temporary and they will be reversed in future years. Permanent differences also arises because of the differences in the taxation laws and accounting concepts, but these differences are the permanent differences. These are the references. Thank you so much.